Okay, so starting overseas, Eurozone industrial production came in. This was for April, so it's old data, but it was a lot worse than people thought. The biggest hit came from motor vehicle production with output down, get this, 85% month over month, April versus March. Auto parts also dropped 58%, and apparel also saw very large declines. Even food products and other non durable customer goods showed a decline of almost 7%. It'll probably bounce back, but I think the shocks here, at least many pundits are saying, were so large that it may take longer than expected for that recovery to get really in gear. Um, then also take a look at Britain. They said a couple of things. They're not going to extend anything with the Brexit. They're sticking to the I think 12/31 date. Uh, but guess what happened to their GDP in April? It went down 20.4%. That is the largest monthly fall on record. And the OECD had already warned that the UK could see the developed world's deepest recession. So unfortunately, they're living up to that prediction. Overseas, though, the markets were in Europe were just mixed. Germany lost 0.1%, although the UK actually gained 0.5%. France's CAC gained 0.5%, and the Euro stock index increased 0.1%. Domestically, we had import-export prices. Import prices went up 1% versus the estimate last month's reading of negative 2.6. Ex-oil, they were up 0.1% versus the prior negative 5%. It's just showing, though, there's still no inflation out there, in spite of the Fed printing all this money. So no inflation in the short term. We also had the preliminary University of Michigan consumer sentiment. Did show an improvement from the previous month. It's at 78.9. That is up from 72.3 in May, and actually beat the consensus, which was 75.8. The key takeaway here is that the uptick in the number was driven mainly by gains in employment and an expectation for a decline in the unemployment rate. But I thought this was also interesting. The survey respondents were not anticipating the reestablishment of favorable financial conditions anytime soon. So kind of a mixed message there. And I don't know, anything else catch your eye today?
Yeah, I'm sorry, Lee. I apologize. No, I think you're nothing specific is catching my eye right now. I'm listening to you. I apologize.
Okay, let us go here and start looking at some commodities. Gold has devolved into a trading range. You're kind of right in the middle of the range, so it's not the best risk to reward. We're kind of range bound, which is kind of surprising given that the dollar has been going down. But anyway, I think your first clue that we might get to the top of the range. Look at, we have those three tails right up there at 1750-ish. So you take that out, maybe you do run up to the top of the range. We're right at the confluence of the 50 and 20-day moving average, but they're relatively flat, and we're in a range. So what we technicians believe, right, Mike, is if you're range bound, moving averages don't work as well, correct?
I think that happens every time, Lee. Yeah, we prefer for trends to be either moving up or down, and then those moving averages add a lot more value than those. It's almost static when they're moving sideways, range bound there, Lee. So yes, excellent point.
Right. So you don't give the moving averages for support or resistance as much weight if you are range bound. Okay, let us take a look at copper, which had a turnaround yesterday. It was a bearish engulfing candle, but the good news is, in general, we have been supporting the equity market advance, but all risk assets took it a little bit on the chin yesterday, as we all know. But hey, that 10-day moving average, which is the yellow line there, they bought it up when it got down there today. I think you've got really good resistance though on the upside of that 265 level, which is that upper dotted line.
Yeah, again, when you're looking at that there, Lee, I mean, I do see the bearish engulfing candle you gave the other day. The day before, we went all the way up to those highs, couldn't really push through that resistance level that you're clearly pointing out. So that's an excellent analysis there. Yeah, I mean, you need to really get a closing price above that for us to say, hey, copper would start to be breaking out a little bit more. But yeah, it's
Yeah.
good to use the 10-day support as a little bit of a moving average right there. So that works well.
Okay, dokie. Let's look at oil. EIA data yesterday, as Mike Zaremski had said yesterday, was a little on the bearish side. So I think key for the short term is look at how we came right down to my support line there. Two tails. Let's zoom in there a little bit. Look at that. Boom, boom. So I think that is a very significant level. That's about, what is that? Yeah, 34 and a half, 34 and 3/4. Also interesting, we've been holding the 20-day moving average here, although the 10-day has been broached. Maybe we're going to get a little bit more range bound in here. But I think a break below 34 you'd have some liquidation selling and we would go down where, I don't know, maybe to the 50-day moving average, but it hasn't happened yet. I don't know, what do you see here?
Well, listen, we've had some crazy volatility in the price of oil going back over what you have here, the last almost 3 months here on this chart. We're having a little bit of a pullback right now. We're pulling back to, as you drew that line where you drew those two significant tails there. That was previous resistance, mid-April right there. Early, I guess, what's that? Early June, late June. Late May, early June, also. So what was once resistance then can become support. And I think your thought process that we might go a little bit sideways right there. That kind of makes sense. After an extreme move that oil's had, a sideways move up a little bit off the bottoms. For those people who like to play oil, gives you a little bit more of an area where oil could potentially kind of find a home for a little bit. So I think as we start to continue to open up the world economies, we'll see really what kind of demand we start to get for oil going forward.
Okie dokie. All right, let's look at interest rates. So let's look at the breakout didn't hold on the 10-year. We're back in the trading range, which is too bad for the financials. It was a good breakout. We almost made the measured move target, which was the height of the previous range. Right? We got up almost there. That's what this line is. It's this range projected up from the breakout level. That's how some traders set targets for a range breakout, but didn't last long. So just back in the range again.
Yeah, tough week. It was already pulling back into the range, and obviously the Fed certainly, giving an indication through 2022 of no interest rate hikes is certainly not going to help. Certainly not going to help the 10-year anytime soon.
Yeah, good point. I should have mentioned that. Yep, the dot plot, just as Mike said, shows no rate hikes until 2023, just like he said. So are we getting a cross back on our trend following TLT system? Not yet, but maybe in a day or two. So we might get whipsawed a little bit in here, but until it crosses back above, if you follow this mechanically, that's what you'd be looking for to go back along the TLT. So the last trade based on this was entry at 138, a sale at 162.
Pretty good trade there, Lee.
It
Pretty
was.
good trade there using just a moving average crossover, which is again,
Yep.
why these things add value to, to traders. It doesn't mean it's going to work every time, but we try to find as many things as we can to support our thesis of what we feel about these stocks and or commodities, whatever we're looking at. But yeah, you'll probably get that fish hook up as long as we can kind of maintain at least an even pricing right now. You know, just a little bit of a trend up would help out as well for that.
Yeah. Okay. Before we look at the U.S. markets, we had been taking a look at this one, which is the Euro Stock 50. Let me go to a different chart. We have a question on this, so we'll take a look. All right. So we are having we told you when it broke out in here, and then you would not have been remiss to take a profit yesterday when it broke the 10-day moving average. So if you want entry and exits here, the next lower risk entry would be right around 33 and 3/4. This gap in here, of course, this is going to gap a lot because it's based on European markets, but you also got the 20 coming up in here. So this would be a pretty sweet spot if you wanted to be long. To enter, your target, of course, would be the previous high with a stop under there somewhere, probably under that low right in there somewhere. But it's still, you'd have to say, Mike, it's still in an uptrend, right? We're still making higher highs and higher lows.
We're still in an uptrend. Again, a little bit of a pullback, maybe a little consolidation, the same thing. Would be a little more negative if we were to fill that previous gap down again. That would not be the most bullish sign, lack of a better term. So that powder blue line that you have hyphenated there in the middle at about 33.78, that's going to be a key spot for you to look. But as you're saying, that might be the next spot for entry as well. So it's always a catch-22. If you want to be bearish, you can say, hey, if it breaks that blue line, you can start to get, maybe get in on the short side. If you want to take the bullish side, that's your spot for entry, right where Lee's got his mouth. I just would have a tight stop on that, just in case we're not able to continue to push back up a little higher. But that would be a good entry spot for either the short or the long. Just depends what your point of view is. But that is definitely an intriguing spot right there on the chart.
All righty, let us look. We had a question on Kroger. I'll just mention it. We don't look at individual stocks really in charting the markets, but I will just say Kroger to our client out there in Washington State. Yeah, it generally moves inversely with the market because it's when you're risk on, it's a staple stock, kind of lower risk, so it doesn't move as much. When it's risk off, people go to safety. I will say that yesterday, Kroger was the only stock in the S&P 500 to be up. So
in the S&P 500 of 497 stocks.
So it was the only one that was up. To the point that it has been trading a little bit on the inverse side. But I think that's the reason. It's considered a real defensive. All right. I'm going to turn it over to Mike to give us, I'm going to just start with no things on my chart. I'm going to put up the S&P 500. I'm going to let Mike just give us some levels. You just tell me what you want on the chart, Mike, and let me take those off too. And then
well, I want to look at two things, Lee.
Okay.
One of the things that yesterday, obviously anybody who's listening to this show, that was a technically, well, was it? That's what I want to see. Was it a technically damaging day? I know you and I I know you had a couple things you wanted to talk about the S&P as well. But from a Fibonacci standpoint, I was looking at it a little earlier this morning. That pullback, that retracement that we had yesterday, I was looking at it a little earlier. Little bit of a level where makes us feel a little bit better, right? So we came right back down in a hurry yesterday. Faster than probably, it was the biggest sell-off that we've had since mid-March, but those mid-March days were probably the biggest sell-off days that we've had in 4 or 5 years. So,
Right.
you have a day like that yesterday, and I'm not putting it back on you, but what do you assess with that yesterday? Pulling back to that 23% retracement level today, having kind of a whipsaw day, an inside candle as we're looking at it right now. We opened up, the futures were up 600. I'm sorry, 500. We hit up as high as 800 this morning, as far as the Dow, and then we were almost turning negative at one point today, and now we've got another red candle, even though we're up 251 points. That's my analysis is, I think, maybe the run up in the market had been a little overdone. If you look at your lows on in mid March and the run up we've had when we reversed the Fibonacci's, we've had quite a retracement from those lows, and now maybe felt that the market got a little ahead of itself and had that big pullback, but it comes to a Fibonacci support level. So for me, I'm looking at these two levels in mid May, right around here. I'm pointing on my pointer that's not moving yours. So go to early May. I apologize, Lee. Go to early May right there. And
Right
we're
there.
pulling back. Yeah, actually go, yeah, right there. And where you
About
are
the
on
38. Yeah.
yeah. So though, we had pulled back to those spots. You see those two highs in there where we couldn't get back above that, that line, which we would ended up calling it resistance. So I feel like the market right now, it was a little extreme yesterday, but I think it's a little bit okay. It's a little bit okay. I'm not saying it's great, but let's take a look. I do like that it came back down to that Fibonacci retracement level. That was what I was looking at this morning. So it could give us a little support, and even after crazy volatility this week, an increase in volatility. Maybe today, we're up 200 points. It would be kind of disappointing after being up almost 800. But maybe if the market just gets us sideways and we don't break down below that Fibonacci retracement, might be a good way to go into the weekend. If you could take those Fibonacci lines off, take a look at where we are from the damage from a moving average perspective. We were trying to push above. So right now you just put on the 50, you put
And
on
then
your
the
20. So we're
one.
breaking down below the 20 that was on a closing basis yesterday. So again, that takes a little steam out of the current rally. But right now, from where we are, again, the high on that red candle is where we opened today. And then the tail is we were up a little bit higher. So now where we are now, the bottom of that red line, that's not, again, that we would prefer to close back above the 20-day for us to hope that this long, the intermediate term trend of the last few months, that we're back into, continue up on that bullish trend in the market. If we were to close below today, below yesterday's lows, that would start to have us getting into another period of making lower lows. So for me, this is going to be an interesting close in the next 2.5 hours East Coast time, just to see where we close. And we've been all over the place today, but that's kind of what I'm seeing. You have the 200 on there, Lee, just for a
Yeah.
second.
Yeah. The blue line there.
Okay, I'm sorry. Yeah, sorry.
Yeah.
Right in front of my face, and I'm looking for it. Just sitting right, sitting right on the 200, which is, it's an interesting spot for the market, right? We're sitting right there on that 200-day moving average, and it'll be interesting. Like I said a few seconds ago, we really just don't want to close below those lows from yesterday. That would just be a big reversal day today. Have a big reversal and close at lower lows. So let's hope from a bullish perspective of the market, if you want to be a bull, we got to get up probably to be about up 200 or 300 more points, another 200 points, just so we can at least turn this candle above the 20-day moving average from a closing basis. That's kind of what I'm seeing. But I know you wanted to talk about a little bit about the breadth of the market as well on the S&P.
Yeah.
We were talking
So,
about that a few seconds ago.
yeah, we were talking earlier, and I just had a couple of kind of interesting charts to show you there. So, the first one actually I did on Schwab.com. All right. So right now we're basically right around 30% of the S&P 500 stocks over the last few days have gone on MACD sell signals. Um, So that shows you the breadth of the overall market is getting a little bit rocky. If you look at times this has happened in the past, you tended to get a little bit more pullback in the short term. Long term, though, again, my view, as you know, has been even before the sell off yesterday, was we were overdone. The options data we talked about on Monday uh, suggested we were going to have a pullback. We talked about the sentiment indicators, some of them. Maybe we have, based on this, maybe we have a little bit further to go on the downside, but it might not happen. I mean, let's go back to the chart again. Mike made a really good point, is if you think, I mean, you're getting a really good entry here if you don't think we're going to pull back more, because you just put a stop under yesterday's low. You're almost there. You got the 200-day right there. Just have a tight stop. It does, what I just talked to you about historically does suggest maybe a little bit more weakness. Maybe that just takes us down to that other level Mike was talking about, was those highs in May. Maybe the pullback continues there, and we saw that was about the 38% level, right, Mike? So maybe we could get down there. The other thing I saw with the breadth kind of rolling over, I want to show you another couple of charts here. So we're going to go over to stock charts now. And what we're going to do is look at the volume, up volume on the New York Stock Exchange as a percent of all volume. And the first thing we noticed is we had gotten a really good breadth thrust at the beginning of the month, where this went to 80 or higher. That was the 10-day moving average of volume was 80% higher. 80% of the volume was in the up. But yesterday did, to Mike's point, yesterday did do some, you wanted to know, Mike, if it did some technical damage, and I think it did. Because now let us look at the 3-day moving average of that, which has, and I'll just show you the last time this happened. This is why I think maybe we might pull back just a little bit more. So we're going to go and take a look at the, where is it? There, 3-day moving average of that up volume, 9%. Look at that drop. Okay. So the last time, you can see the last time we got down to, that
These
was right
extreme
here.
levels. Yep.
So that's just making me a little wary of the short term path of the market. We might go a little lower, but we might only go down to where you saw that level. But this is just a little worrying. Also, if you take a look at historically, when you have had a 3-day plunge on this indicator below 15, it hasn't been great for the next month, but if you're a longer term investor, it didn't really mean anything. The market was higher 86% of the time a year later. But it did suggest choppiness and weakness, just like some of the things we talked about yesterday, choppy and weakness over the next few weeks, for what it's worth. Anyway, that's what, go ahead. Yeah.
No, that's excellent. That's excellent. And to further support you, if you look at our last question from Barry in Minnesota, he's asking us to draw those Fibonacci lines the other way. So we drew it from the bull perspective to see the technical damage. He's saying that we're hitting some resistance. So let's take a look at that, because we have done that before, where we look at it from both sides, from the bullish side and the bear side, and it's not often on a chart that we go from bull market to bear market that quickly, So I'm just going by Barry's question, and you're drawing it up there, and he was seeing a little bit of resistance up there, right? So again, where we ran into where he's saying that we ran into resistance right there, but that's kind of from where the gap down was, right? So
yeah, I would just say that a lot of technicians, when they do Fibonacci's,
Mm-hmm.
uh, which way do you go? And I'd say there's kind of a rule of thumb that if you're starting to, until you start seeing higher highs and higher lows, uh, you do the downward. Once you start seeing higher highs and higher lows, then you start going the other way when you make a peak. But to Barry's point there, it's very interesting though. Maybe this is what he was talking about too, Mike. That 61.8% level uh, is right near the place that you saw, which was those May highs. And as you know, when we were talking about the decline, if when you get above the 61.8% level of retracing the decline, that generally suggests you're not going to go down and test the low. And that's what's been happening. But that's a very interesting area. If we cannot hold yesterday's low, to your point, then I think that's where we're going to drift down to, is about 29.40 to 29.50.
And
Yeah,
we could drift down there in about 3 seconds, right? So
exactly.
again, this is, it's been an extremely volatile market, since the word COVID-19 came into all of our vocabulary in the middle of February, right? So it's, this is not, I don't want to say it's unexpected or unhappy with it, but it's, this is part of the market. This is why everybody who's listening to us likes it, because they like the volatility. Traders like volatility in the market when they're on the right side. When they're on the wrong side, they don't like it so much. But the market's bringing some volatility. As you were saying, the breadth, it is declining. We're just really seeing a real big push into some of the, as you're going to hit up the NASDAQ in a couple of seconds from now, I'm sure, it's the power in the NASDAQ is really driving a lot of this in the market right now.
Yep.
Let you move to your next index, Lee.
Yeah, look at that pullback again, right to the 20. So key level here too. We are very close to yesterday's lows, aren't we? Then again, if you want to join the trend, you're right at it, right, Mike?
Yeah,
If a stop under yesterday's low, you got a chance right here.
Yeah,
If you want to go long.
if you want to go long, and the other side of it, if you want to go short these guys, right? Open your stop up if we break below that low. If we break below that low, that's when you would start to think about opening that stop, opening up that position on the short side. I think I just said stop. You might want to open up that short position if we were to break below those lows from yesterday. If you're on the bullish side, because we're in an interesting spot on both of these charts, on the
We
S&P
are.
and on the NASDAQ, where you can get the bulls and the bears fighting it out, which they fight it out every day of the week. But from a technical point of view, which is what we care about, you're at an inflection point for both sides of the market, which could further just push us into this sideways move that we were talking about earlier, that we just might meander sideways for a couple of weeks. But we will see.
Right.
We will see. That's what makes it excitingly.
Right. So if you did break that, your first trading target would be around 9,200-ish.
Lee, last time I checked, that's 300 points off of the Nasdaq. That's not
Yeah.
it seems like a small drop when you're drawing it on the chart, but the power that the Nasdaq has had over the last couple of months is unbelievable. So that would be a bigger percentage drop than that chart is giving us the perception that's really out there right now. That's a big drop.
Yeah, it is. All right, let's take a look at the NASDAQ 100. Man, same thing.
It's being driven by these monsters of the Nasdaq.
Yeah.
It's when you said the breadth of the market, I think there's apparently the market thinks there's like 7 stocks out there.
Right.
I'm being facetiously sarcastic, but it's the monster. It's those FANG stocks. The monsters are the midway for the Nasdaq, and they're really driving it. The power that the Apples have had this week. Apple's been an extremely strong stock. They're they're performing well on the upside, and on the downside days, they are doing better than the stocks that are going down. So it's That's to be expected from the NASDAQ. Again, same thing that we've been saying, hanging on that 20-day moving average. It's a huge cliff from the 20 to the 50. I mean, that's a big gap in there, Lee.
It is.
And we wonder what, where the speed comes from on a day like yesterday. You would see that probably fill in pretty quickly if we were to start to go and break down below yesterday's lows.
I
So
think so.
yeah,
Yeah. So we're at a key level. Now, let's talk about, I mean, I don't know the answer to the question I'm going to pose myself. I'm going to pose it to everybody.
I love those questions, Lee. Go ahead.
Yeah, the question is, so you've had this big down day yesterday. You're fading a little bit today. Will people feel good or bad about holding over the weekend? Now, it used to be that you were really fearful of the news being worse, but I mean, a lot of the news, I mean, maybe people are thinking maybe they'll start buying it towards the close, just saying, I think the only news surprise over the weekend would be positive of some sort. So I don't know the answer to that question. The market will tell us if we take out yesterday's low. But
And I think you're right. I think I don't know that there's crazy risk factors currently out there of anything that we don't already know, right? You know, COVID-19 risk factors, which I was reading tons of articles this morning. That's why the market sold off yesterday. They
right,
said everything in the world. COVID-19 across the world, we already know. We don't know the cure, obviously, but we know a lot of the data. Right, and we look here in the United States selectively. All right, we're seeing a spike in some of the states that increased. I'm not saying that that's good by any stretch of the imagination. All right, but all this was known. This was all known as the market was rallying up over the last couple of weeks. That there could be this potential for it, but yet the market kept on going higher. So it'll be interesting to see what goes on as we're hitting towards the lows of the day. Even right now, only up 133 on the Dow, barely positive on the S&P. We're going to start to see, do people want to take that risk over the weekend? And that risk over the weekend that just might be, I don't know that I want to take that risk for the next couple of months, right? That might be somewhere where we're entering. We've had like that tremendous bounce off from the mid-March lows to here, and now people might be happy with those profits. Those are shorter term profits. They might just take them, and maybe the market just gets into this period of summer doldrums, and we just start to you know take the air out of the market a little bit. So yeah, right now, look, we're almost below those lows right now on that candle perspective
yeah, let's go to an
as we're
intraday
talking.
chart.
As we're talking.
Yeah, so this was yesterday. Look at, we're right at it. Oh my goodness. Too bad we can't stay on till the close. But
Play by play
wow,
till 4. Yeah, but that's what
wow,
it is.
right there, right there. If we break that, yeah, it's going to be
It'll be an ugly hour and a half at 4 o'clock or 3:30, 3 to 4 here on the East Coast. That's what we're going to start to see.
right. Now, when something like this happens, what's going to happen if it did break? You're going to see stops going off, so you get a spike down, but then it'll rally back up, and it's when it rallies back up to taste, to where the stops went off, that's going to tell you. Because we could go down just a tick or two. There's stops right under there. Push it down, but then they'll go back up, and that's what you want to watch. Will the recovery after the stops go off get you
Become
back into
resistant.
this range, or will they stop right there?
Nasdaq just turned negative as we're talking.
Yeah.
Right, and again,
Well, I told you my breath data said this might happen, but
you're like Nostradamus, Lee. That's
yeah,
what you are. And yeah, listen, this is what we like. This is what we talk about all day long with our clients here. At Schwab, we don't like the market going down, obviously, but we talk about, what's your opinion, and some clients are buy and hold and they don't care about all this. And then there's plenty of clients that are listening to us every day that really care about these intraday moves. And these intraday moves are what make up the bigger picture in the market, right? So we're watching for these little technical holes in the market. Unfortunately, we're looking for a hole right now if this were to break that level that we have on the screen. So
yeah. All right, people had some good ideas. Let's look at the equal weighted. S&P, and we'll look at the equal weighted. Uh, so the equal weighted is below the 20, where the market cap weighted, well, they're both below it right now.
Go back to
Oh,
equal weighted, you're below the 200.
oh, I didn't see that. Let me go back. That's why we got Mike on. Okay. Yeah. So you can see the difference, right? That the FANG stocks are having. Um, yeah.
Yeah, I mean, that's an ugly move yesterday. That's a technical breakdown for the broader part of the market. Equal weighted yesterday. Not only did we push through the 200, which is a relatively flat line, we pushed down below the 20-day as well. So today we got that long tail up. That tail up looks like we tried to push back above the 200, barely. It became a little bit of resistance at the highs of today, and then we just, sold right back off down to towards, I'll call it, we're very near the lows of the day. So yeah, from an equal weighted basis, as you already pointed out, the breadth of the market's just not there right now. It's really just the few soldiers of the Nasdaq that are really driving this market.
Yeah. So now let's look at the this was the other part of the question. Look at the Qs, and Nasdaq 100 holding the 20-day right now. Now let's look at the equal weighted Nasdaq 100. Yeah, a little bit. Well, it's not that
A little
bad,
bit
but
better. It's a little bit better than what we just saw in the S&P 500.
yeah,
Right?
but it's still lagging though. Not quite as badly though. Interesting. All right, let's take a quick look at the Russell.
Lee, show me something that right there.
That's not great.
Right, yeah. I mean, usually we look at these the Russell, the small cap index is leading the market, and if it's leading it right now, which it's been a little bit of a laggard over the last over the last 2 months, but really picked up steam over the last 2 weeks or so, where it's taken a little bit of a head for a leadership role for the market. But that move yesterday, couldn't get above the 200. We were above it. Now, and then it proves to be a resistance level. We pull back in, break down below the 20. Yeah,
Yeah, I mean, to your point, Mike, that tail today that failed at the 20 is not a good sign.
mm-mm. And that's returning red on everything right now, as I'm
Yeah.
looking on your screen. Yeah, that's
Mhm.
again, I'm not depressed for the market. We always want to see, we always want to get a bull move in the market every once in a while. But yeah, this is the market's coming in a little bit of a hurry right now.
Yeah, that's right. So, I mean, really, though, even if it goes down to those levels that we talked about earlier that Mike had pointed out, it really doesn't do anything to destroy the longer term intermediate uptrend. It just means what we don't want to do is if we go back into that range, let's take a look at the S&P again. Yeah, so, I mean, from a longer term perspective, let's take off everything here. From a longer term perspective, even if you got down to 2,800, it wouldn't be bearish in the intermediate term. So we're having a pullback. They always feel terrible when they're happening, but probably we're going to drift down there. But as I said, even if we can hold in here, all it does is say we got a little ahead of ourselves, and now we're fair value 2,800-ish, and that's still okay for longer term. All
Right.
right, let's just
Hey,
yeah.
what I was saying, take a look at the weekly chart. That one interesting statement right there that I just saw in one of our questions. Yeah, that's ugly. Good point, Alan. There you go. Yeah, I mean, so Alan, one of our clients out there in Ohio, just pointed out, a bearish engulfing candle on a weekly basis. There's no chance that weekly basis is going to turn bullish within the last hour and a half now, Lee.
No.
That's a pretty bearish candle of a, and let's call it, it's a really nice move off of those lows in March, but that could break the trend on a weekly chart that Alan's pointing out right now with that bearish candle that's forming right there. We've got that resistance that was a resistance level for the market that Lee just drew. That could be the next support level that Lee's drawing on there right now. Give or take about another,
29.50. Yeah.
yeah, another 50 points lower on the S&P from here, which we could probably do in 5 minutes. So you never know. But yeah, excellent analysis there, Alan. Thank you. Thank you.
Yeah, let's go back and take a look at the. So we are bouncing off the short term. I mean, this is what I'm watching. Let's so right now we're holding it, but that's a key level to keep your eye on, everybody. Was at 29.97-ish. So, all right, let's take a look at the sector action real quick. We don't have a lot of time, but we'll just take a look here.
I'm willing to go 1 minute over, Lee, just so you know.
Hey, I'm not. No, I'm just kidding.
That's a little joke for the production guys, everybody. That's just a joke for those guys.
Okay. So, well, the airlines are still up. Mortgage REITs are still up. Interesting even with the EIA data. Let's take a look at the energy patch because it's doing okay. Let's see. Let's take a look at the oil service. Let's go to a daily chart. Well, they're holding up. I mean, they're up today, but you'd have to say I have a feeling that's going to probably drift down and totally fill that gap at this point, though. What do you think?
Yeah, unfortunately, it seems to be that way. I mean, you had a nice move on the breakout of those two lows, right? Look at
Right.
draw that line that you just drew down there on the bottom, that resistance line. You had a nice little breakout, and then just completely reversing the entire move it made over the last week and a half. Right now, these oil service stocks.
Right. So the place,
Right
maybe
there,
if you want to try to get long again, is right there. Yeah, 115.5. Let's take a look at jets, the airlines. They got trashed yesterday. Now they just rallied into resistance, and now they look like
turning the other way as well.
yeah.
And I know Lee, but just for everybody out there, red candles are never good. Whether they're up on the day or not, when you open higher and close lower, it just really shows a difference in sentiment or trend internally for those stocks. And we opened higher trying to gap up after a horrible day yesterday, and even though we're up 7.7% to them, they're still lower than where they opened this morning. The open today was what, 1852?
Yeah.
1776.
Yeah. All right. Let's see what else is moving or not moving. Oh, steel. Let's take a look at the mortgage REITs, because they had a nice breakout and then they gave some of it back. Let's see if they're still holding. Yeah, so they pulled back right to where you would think they would. So maybe you're getting another chance if you like that area. 24.20, right in there.
Continued low interest rates for the next 2 years makes that sector a little more attractive, right?
All right, it does. So let's take a look. Speaking on that, let's take a look at the home builders again. So, well, they broke their channel line. Still a relatively outperforming group, though. But you could still pull back even to 38 and still have made higher lows.
Yeah, I mean, that again, what you would expect, right? We're keeping interest rates low. Interest rates have been low for the last 2.5 months. the economy is starting to open back up. There's been some pent up demand, and there's been some created demand by that lower interest rate. So we would hope, and I'm sure the powers that be in the country would hope that there is creating demand for for people to to build a new house, to move someplace else, not move out of the country, but to find a new place. This is what we want to keep our economy growing. Why do you think you look at copper every day, right?
Right.
We want to see industrial, we want to see the economy expanding. We want to see people buying houses, and yeah, this was a good move for these guys. This has been a good, solid move since the middle of March.
Yep.
Not quite back to the highs, not the same power that we saw, similar chart pattern to the Nasdaq, but we haven't broken to new highs. But all right, we've pulled back in a little bit, but not horrible. Not horrible. We've looked at much worse today, Lee. Looked at much worse.
Yeah, it's trying to hold the 20-day right there too. That's kind of interesting. You'd have to say it's fighting it out there. Okay, and with those words of wisdom, we're done for today, but Schwab Live Daily is not done. Coming up next, a special Modern Wealth Strategies show covering a very important topic, the importance of having a liquidity strategy. That'll be with host Patrick Means and also Bill Roberts. So stay tuned for that. Thanks again, Mike. Have a good weekend. Have a good weekend, everybody.
Thank you, Lee. You too.